In recent months, more and more signs indicate that the Middle East is gradually following Asia's path, reducing its dependence on the dollar and increasingly shifting to settlements in national currencies and gold. This process cannot be called abrupt or demonstrative, yet its consistency and scale are prompting analysts to speak of a structural shift that only a few years ago seemed unlikely. According to experts, a key factor accelerating these changes has been the policy of the Donald Trump administration, which is increasingly perceived in the region as a source of instability and direct risks. This is not only about sanctions and tariffs, but also about harsh rhetoric, threats of forceful scenarios, and, above all, the possibility of a military confrontation with Iran, which, according to analysts, could once again set the entire region ablaze. Experts emphasize that memories of past wars in the Middle East remain fresh. Any major U.S. military intervention automatically affects energy markets, logistics, and financial flows. This is why regional governments are increasingly viewing the dollar not only as a convenient unit of account, but also as a potential source of vulnerability. The use of the U.S. currency amid sanctions and threats of blockages is increasingly seen as a risk that cannot be fully controlled. Against this backdrop, interest in alternatives is growing. According to analysts, Gulf countries are gradually expanding the use of national currencies in bilateral settlements, especially in trade with China and Asian countries. Oil and gas supply contracts are increasingly discussed in formats where the dollar is no longer without alternatives. This does not mean abandoning it, but it does create room for maneuver for the region. Gold occupies a special place in this transformation. Central banks in the Middle East have noticeably increased their gold reserves in recent years, viewing them as an asset independent of the political decisions of any single country. Experts note that the rise in gold prices largely reflects this demand, which is long-term and strategic. Gold is once again becoming an instrument of trust in a world where the financial system is increasingly used as a lever of pressure. Another important factor is the threat of escalation around Iran. According to analysts, even the mere possibility of a military conflict sharply increases market nervousness and forces regional elites to seek ways to protect themselves from potential shocks. If a conflict were to erupt, dollar-based settlements could come under pressure due to sanctions, restrictions, and disruptions in payment chains. That is why the shift toward national currencies and gold is seen as a form of insurance rather than a political gesture. Experts stress that this logic is increasingly discussed at the level of regional forums, albeit without loud statements. An additional role is played by China's growing influence, as it has become a key trading partner for many Middle Eastern countries. Beijing is actively offering settlements in yuan, currency swaps, and alternative payment mechanisms, which aligns with the interests of regional states. For them, this is an opportunity to diversify financial flows and reduce dependence on a single center of power. Analysts note that it is precisely the combination of China's economic presence and Washington's hardline policies that is accelerating de-dollarization processes. At the same time, it is important to emphasize that the Middle East is not seeking an open rupture with the U.S. Regional leaders are acting cautiously, trying not to provoke confrontation or take abrupt steps. However, the overall direction is becoming increasingly clear. In conditions where the threat of a new conflict with Iran is perceived as real, a bet on financial diversification looks rational and pragmatic. Experts agree that the policy of pressure and ultimatums pursued by Washington is paradoxically pushing partners to look for alternatives. Instead of strengthening the dollar as a universal instrument of trust, it is reinforcing the desire for autonomy. As a result, the Middle East, like Asia, is gradually building a more complex and multi-layered financial architecture. The dollar remains an important part of the system, but it is no longer its sole pillar. And if the threat of a military confrontation around Iran persists, these processes, according to analysts, will only accelerate. In the long term, this could lead to the formation of a world in which energy-producing regions are no longer willing to be fully dependent on the currency of a country whose policy is perceived as a source of constant instability. Against this background, analysts increasingly emphasize that for Middle Eastern countries, moving away from a rigid dollar peg is not an ideological choice and not an attempt to challenge the US, but a reaction to a sense of lost predictability. The region remembers too well how periods of sharp escalation end and therefore tries to build protective mechanisms in advance. When threats of a military strike on Iran come from Washington, regional markets immediately price in the risks of supply disruptions, sanctions pressure, and financial restrictions. Under such conditions, the dollar ceases to be a safe haven and is increasingly perceived as a potential crisis trigger. That is why central banks and sovereign wealth funds in the region are actively diversifying reserves, reducing the share of U.S. assets, and increasing allocations to gold, alternative currencies, and real assets. Experts note that this process is especially noticeable in oil-producing countries, for which financial stability is directly linked to energy exports. Any conflict around Iran automatically puts key supply routes at risk, and therefore foreign currency revenues as well. In response, governments are increasingly discussing settlements in partner currencies in order to reduce the risk of blockages and freezes. The growth of regional cooperation is also becoming an important element. According to analysts, Middle Eastern countries are increasingly discussing among themselves mechanisms for mutual settlements and clearing that would allow trade even under external pressure. These initiatives are still at an early stage, but the very fact of their discussion points to a deep shift in elite thinking. If previously the region's financial system was built around Western institutions, now the idea of the need for its own instruments is heard more and more often. The factor of trust also plays a significant role. Threats of forceful intervention that periodically come from Washington undermine the sense of reliability of previous arrangements. Even U.S. allies in the region are beginning to ask how safe it is to hold key reserves and conduct settlements within a system that can be used as a lever of pressure. Analysts stress that it is precisely this psychological moment that becomes decisive. Financial systems rest not only on numbers, but also on trust, and in recent years it has noticeably weakened. In parallel, the role of gold as a universal insurance asset is growing. In conditions where currencies can be frozen or restricted, physical gold is perceived as the last line of defense. Central banks in the region are increasing purchases, and the private sector is showing growing interest in precious metals. The rise in gold prices, according to experts, reflects not so much speculative demand as a long-term drive toward security. In this sense, the threat of a new conflict with Iran acts as a catalyst. The higher the risk of escalation, the faster the reassessment of reserve strategies proceeds. Analysts also draw attention to the fact that what is happening in the Middle East fits into a broader global trend. Asia, Latin America, and now the Middle East are increasingly talking about the need for financial sovereignty. The policy of hard pressure pursued by Washington, instead of consolidating allies, is gradually forming in them a desire to have a backup plan. As a result, the dollar does not disappear from the system, but loses its status as an unconditional anchor. For the U.S., this means a weakening of one of its key instruments of influence, and for the region, greater autonomy, but also greater responsibility for its own stability.